get straight to the markets more broadly. Joining the show is Warren Pies, 314 Research co-founder, and Charlie Babrinskoy, Ariel, head of investment group. Welcome to both of you. Charlie, I'll start with you. I mean, it really was the mega cap tech names that led the move higher here today, with the NASDAQ outperforming, finishing up about 1.8%. And we've been talking about rotation in recent days. We've been talking about a broadening of this rally. Your thoughts on where we are right now?
It didn't happen today, but there's no doubt that when we look at stocks and what's attractive and what's expensive, it's very clear. It's the tech stocks, the defensive stocks, the non-cyclicals are very expensive, and the more cyclical value names are what's attractive. So everybody's talking about how expensive the market is, how it's been up so much. A lot of our more value names are very reasonably priced at 10 times, 9 times earnings. We didn't get that rotation today. We are seeing signs of life in our value names as it becomes more and more likely that we don't have a recession. These are the kinds of names that are going to catch up from a valuation point of view. Yeah,
we keep talking about it, Warren. The fact that data has so far been pretty Goldilocks. You know, you're seeing disinflation, including today with the PCE. You're seeing the economy continue to, yes, maybe it's softening, but it's continuing to grow. Consumers are continuing to spend, at least to a certain extent. What does that mean for your investing thesis here, since I know you have been cautious in the past?
Yeah, I think that the story of 2023 is really the economic strength that nobody really predicted. I mean, this is the most consensus call coming into the year was a recession. And basically, this has been a year where that trade has had to be unwound. We increased our equity exposure back in early June, and we basically like stocks and commodities over bonds. That was back when we got that, I'd say it was a really good May jobs report, and it became clear to us that this recession was not going to happen until probably somewhere at the earliest, the middle of 2024. So from there, you know, a lot of trades flow from that.
We like commodities. Oh, sorry, go ahead.
Go ahead, John. We like commodities. We prefer stocks over bonds, but the least attractive asset in this environment is the bond market, particularly the long bond.
Okay. Well, you say no imminent, Warren, recession means stocks over bonds, but that's kind of a trade, right? I mean, if people right now have fewer bonds in their portfolios than they have historically because yields have been pretty terrible over the last several years, it doesn't necessarily mean, does it, that they should stay that way? I mean, won't people years from now be saying, oh, I wish I had locked in some of those yields in 23 and 24 when interest rates were so high?
Yeah, I mean, well, we're looking at specifically the long bond. And the long bond, to me, is overvalued. You know, you can look at it from a number of angles. If you base it on nominal GDP, I think the long bond is about 100 basis points too low. If you think about the Fed hike cycle, usually at the end of a Fed hike cycle, the 10-year ends on par with the Fed funds rate. Today, we're 160 basis points below that. And then you think about term premium. This is the amount of additional yield that a long-term bond investor requires for locking their capital up. Term premium is negative. So you're actually not being paid that additional premium to hold and lock up your capital. So across all these perspectives, we think long bonds are overvalued. And really, all roads point back to how the Treasury has conducted its issuance patterns over the last 6 or 12 months.